Global interest rates resemble a marionette, manipulated by their puppeteers, the central banks. Yet, what happens if the puppeteers start losing their grip? Over time, central banks across the globe have strived to steer interest rates, leveraging these as tools to either stimulate or cool down the economy. However, this control seems to be gradually eroding. The traditional theory of central banks controlling rates seems to be less effective now than ever. Their attempts to control rates have turned into a high-risk gamble, the stakes being policy error and the eradication of natural rate discovery. Let's delve into this. Policy error points towards possible blunders made by central banks in bid to maneuver interest rates. Such mistakes could trigger unexpected economic domino effects. For example, maintaining rates excessively low for a prolonged period can ignite asset bubbles and overheat the economy. Conversely, hiking rates rapidly can strangle economic growth. The removal of natural rate discovery, conversely, is a direct ramification of central banks' endeavors to control rates. In a natural rate process, the interest rates are dictated by demand and supply for money. However, when central banks step in and meddle, they override this organic process, leading to artificially established rates that might not mirror the real economic conditions. In recent years, a novel risk has emerged, especially in an interest rate environment where rates are increasing unexpectedly. When interest rates rise, as they did in 2022, the traditional correlation between bonds and stocks can break down. This means that when stocks are falling, bonds, which usually perform well in such situations, can also decline. This adds another layer of risk, especially if both bonds and stocks drop simultaneously, exacerbating losses. The year 2024 could potentially see this same scenario. It has become crystal clear that these central bank policies are not just becoming less efficient, but are also fraught with peril. They have resulted in a synchronization of global interest rates, acting more as a barometer of global economic demand, apprehension, or crisis, rather than a simple economic management tool. The major financial crisis from 2008 to 2009, along with the more recent coronavirus pandemic raging from 2019 to 2021, are stark illustrations of this. In these scenarios, central banks globally coordinated their actions to drive down rates to zero in an effort to stimulate demand. However, this led to a precarious situation where some global interest rates were at zero or even ventured into the negative territory. A phenomenon not predicted by textbook theories, and yet, as we approach the end of 2023, we find ourselves celebrating the demise of inflation based on recent data trends and the likely scenario of the Fed cutting rates soon in a twist of irony. Banks worldwide are engaged in a perilous game, with the shadow of economic catastrophe hovering ominously. The question that arises now is, how long can this game continue before we confront another economic crisis? Let's turn back the clock to 2008, to a time when financial institutions were collapsing like dominoes. This was the year when the Great Financial Crisis, also known as the GFC, gripped the world economy and the foundations of the financial world trembled. Imagine a scenario where investment banks and mortgage companies, the giants of the finance world, were crumbling one after the other. The unseen financial iceberg was not visible to the public nor government officials. It felt like a perfect storm where the waves of panic and anxiety were sweeping across the globe. In the midst of this chaos, the Federal Reserve, the European Central Bank, and the Bank of Japan took a united stand. They coordinated their actions and, in an unprecedented move, reduced rates to zero. This was a desperate attempt to stimulate demand, to infuse life into the stagnating economies. But why zero, you may wonder? The idea was to make borrowing cheaper, to encourage spending and investment, to kickstart the economic engine, and to allow an artificially low refinance rate for troubled assets, government spending and corporate and household debt amounting to a jubilee for asset owners. But this was no textbook maneuver. This was an emergency measure, a deviation from the norm, a step into the unknown. The impact was significant. The zero interest rate policy, or ZIRP as it's often called, was like a defibrillator to the heart of the economy. It provided the necessary jolt to keep the financial system alive. But it was not without its side effects. The most notable among these was the insolvency of many large investment banks and mortgage companies, who ended up being merged or acquired, often with government subsidy and influence regardless of taxpayer agreement. The reduction in interest rates had a domino effect. leading to lower returns on fixed income investments and a sharp increase in the need to take on risk through equity exposure. The fallout was severe and still ripples today. Financial institutions that were once considered invincible went through being on the brink of collapse. Some didn't make it. The Great Financial Crisis was a stark reminder of the fragility of our economic systems and the power of fear. It was a lesson learned the hard way that when the winds of change blow, even the mightiest of institutions can fall. And it underscored the need for sound economic policies and the perils of policy errors. It was a wake-up call for the world, a call to rethink, reassess, and reinvent. Fast forward to the end of 2019, when a global health crisis once again sent shockwaves through the economic sphere. This time it was the coronavirus pandemic, and its effects were far-reaching, influencing global interest rates in unprecedented ways. Picture this. The year is 2020 and the world is grappling with a rapidly spreading virus. Fear and uncertainty pervade the global economic landscape. In response to the escalating crisis, central banks worldwide, including the Federal Reserve, or the Fed as it's commonly known, make a bold move. They decide to keep interest rates low for an extended period, a strategy that on the surface seems like a viable solution to stimulate demand and mitigate the economic damage, but here's the twist. This lower for longer strategy didn't pan out as expected. Instead, it led to a series of policy errors that would have long-term implications. These artificially low rates, which were held at near zero levels, ended up creating an economic environment that was ripe for volatility. The year 2022 rolled around, and the ripple effects of these policy errors started to become evident. The Fed and other central banks were cornered into a position where they had to increase interest rates more aggressively than they had in the past. This sudden shift was a direct consequence of their earlier decision to keep rates lower for longer. The fallout from these policy errors was severe and still lingers today, with housing, rents and cost of everyday items markedly higher, but not wages on a relative basis. The aggressive rate increases not only disrupted the financial markets but also raised questions about the effectiveness of central bank policies. And yet, despite the clear signs of instability, these lessons seem to fall on deaf ears. In the end, the 2020 to 2021 pandemic served as another stark reminder of the risks associated with manipulating global interest rates. It exposed the vulnerabilities in our economic systems and underscored the need for more effective policy making. The pandemic served as another harsh lesson in economic instability, but it seems the lessons have yet to be learned. As we face an uncertain future, one can only hope that the powers that be will take these lessons to heart and make more informed decisions moving forward. What lurks beneath the surface of our financial systems is a potential disaster waiting to happen. Consider this. Large banks and institutions have been encouraged to hold longer duration bonds on their balance sheets. These bonds, purchased at a time of low or even zero interest rates, may seem like a safe bet. But what happens when interest rates begin to climb, as they did in 2023? You see, there's an inverse relationship between bond prices and interest rates. When one goes up, the other goes down. So while these long-duration bonds may have seemed like a good idea at the time of purchase, their value could plummet once interest rates rise. This isn't just a theoretical concern. We've seen it happen before. The SBV and other banks have collapsed due to cash runs driven by fear and rumors of balance sheet impairment. And yet, despite the lessons of the past, many bankers, fully aware of the bond market dynamics, have chosen to hold on to these longer duration bonds. They're playing a risky game, betting on the hope that the Fed will lower interest rates and will stay low for longer. But what if they're wrong? What if, after a wave of fear and demand for the safety of bonds, rates move aggressively higher? This scenario, while not widely discussed, is not only possible but may be more likely now than at any other time in history. The potential fallout from such a scenario is staggering. We're talking about billions, if not trillions of dollars at risk, held on balance sheets as bond assets. A sudden drop in bond prices could result in massive impairment and possible insolvency if these assets were to be marked to market. And that's not even considering the potential impact on commercial real estate with high vacancy rates, work-from-home trends, and commercial banks backing. So, while the world may seem calm and the fear of failing banks may have subsided, we find ourselves on the precipice of a potential financial disaster. Billions, if not trillions of dollars are at risk today in our financial systems, and yet the world seems blind to it. As we gaze into the future, the waters of our global economy remain murky. The prospect of ongoing deficit spending, fueled by a seemingly insatiable demand for funding, looms large over nations already burdened by towering levels of national debt. This economic high-wire act is playing out against a backdrop of uncertainty that is all too familiar. It's an echo of the past, a grim reminder of the consequences of financial missteps. The stakes are high as we consider the implications of these policies. As governments continue to borrow, the weight of the debt grows. Many reference the historical capabilities of government to borrow near endlessly and cite that there was no real impact, including low interest rates to accompany deficits, and that is true. But it is also true that at some point, possibly in the near future, the markets will question exactly how far the government debt balloon can stretch without a big pop. And it's not just an issue of numbers on a balance sheet. The real-world impact of these policies is felt in the pulse of our global economy. The risk of inflation, default, and the erosion of fiscal stability are all very real possibilities. In this complex dance of numbers and policies, a seemingly overlooked player is the commercial real estate sector. High vacancy rates, a direct consequence of the shift towards remote work, have left a trail of losses that are yet to be fully realized. Commercial banks, the financial backbone of this sector, are in a precarious position. Supporting an industry that's on shaky ground is a risky gamble, and when the bets are counted in billions, the potential for catastrophe is clear. The bonds that once seemed like a safe haven are now a ticking time bomb. Notably because commercial financing is less than residential, often with 10, 15 or 20-year maximum loan financing with the need to refinance as part of the sector norms. With interest rates set to rise, the value of these bonds and individual project financing or refinancing is expected to plummet. The inverse relationship between bond prices and interest rates is a well-known fact, yet many institutions in their quest for short-term gains have chosen to ignore this. The result? A potential financial disaster waiting to happen. The stage is set for a potential financial disaster, and it's high time we start paying attention. The waves of uncertainty are growing, and as they crash against the shores of our global economy, the fallout could be devastating. Now more than ever, we need to take a step back, reassess our strategies, and prepare for the storm that may be brewing on the horizon.